along, ladies and gentlemen. I'm Hiraldadia. We have with us Mr. M.V. Srinivasan, BP at McCly Financials, joining in. Welcome to the show, Mr. Srinivasan. And always happy to hear your views as well and your expertise coming in there. My first question coming to you is, firstly, we have the RBI monetary policy today. How has the bond market actually reacted to the same?
The RBI policy, it is slightly hawkish in the sense that about 40 basis points they have hiked the reverse repo rate indirectly. They have introduced a special deposit facility so that excess liquidity can be mopped out easily. This is the only factor that was very clear from the RBI's policy. The second was the rise in the inflation forecast to 5.7%. It's very close to the 6% target. So, but the RBI governor has not given any time frame or any clue as to what will be the future action, whether they will hike interest rates immediately, whether there will be a big reversal in the liquidity, excess liquidity. All these things he has not given a very clear roadmap. What he has only said is the situation is dynamic and we will play according to the situation. So right now, a 40 basis point rise in the reverse repo rate means that could be a small increase in the lending rates and there could be a small increase in the deposit rates. May not be to the extent of 40 basis points, maybe about 0.25% or 20 basis points or something like that.
Right. So overall, if you think about the commentary that came in as well, Shaktikanta Das actually, has presented a hawkish commentary on the state of affairs of the economy and on the inflationary pressure. However, has stayed away from tightening the monetary policy by increasing the interest rates. So is it that he's actually preparing the market for a rate hike in the near future? And if so, is all of this already priced in the bond markets currently?
Bond market has priced in approximately 50 basis points rate hike already. This is what I understand from around 6.50 to nearly 7.03%. It has gone up. The 10-year bond yield. There is a substantial rise in the short-term bond yields also. So that is already priced in. But further rate hikes has not. The RBI governor. See, one thing is that from the past meetings, the Reserve Bank is slowly preparing the market for liquidity withdrawal first. And then slowly, probably the last quarter of this financial year, that might be a rate hike. Some bond market players are expecting a rate hike by August. But from whatever the RBI governor has been talking today, I don't see a rate hike immediately coming in August. But whatever he is saying is we are closely watching the situation and if required, we will act. So there is no open admission that we are worried about inflation at the moment.
Right. So overall, if you see in terms of where the bond markets are concerned, firstly, globally crude prices are on a high. US central bank is determined to lift interest rates aggressively, and that's roiling the bond markets worldwide. However, the Indian bond market or the debt market has been largely unruffled for the past couple of months. So what is it that is keeping us so resilient?
See, we have enough liquidity in the market in the first place. If you see the latest data, the excess liquidity is approximately 8,73,000 crores. One. And the bond market reacts in such a way that whatever the central bank, any bond market looks at the central bank, what is the tone of the central bank, whether the central bank is prepared to really address the inflation situation and things like that. So if you look at the Federal Reserve or US bond market or any other bond market, the bond market reacts whenever there is a comment from the central bank people. But from our side, we have not seen any hawkish comment from any of the central bank committee members. One. But still, we have seen about 0.5% move in the bond yields from around 6.5 to slightly over 7%, we have gone. That could be because the secondary inflation is yet to pick up. I mean, in the sense that the core inflation data is yet to pick up. But yeah, central bank hiking interest rates cannot solve the problem of the crude prices and the food prices. Both these cannot be controlled by the central bank. Probably the central bank thinks like that. When the secondary inflation starts picking up, central bank will start acting. So at that time, probably the market will start looking at it and start hiking. I mean, pricing higher yields. Second is that the credit offtake. The credit offtake has been very moderate, like around 8%, 8.5% last financial year. And they are not expecting a very big credit offtake in this year also. Maybe slight, maybe another 1% hike increase in the credit offtake is possible, probably around 9%. So if there is a strong credit offtake from the corporate side, bond yields will start hardening. The third is the fiscal deficit. If fiscal deficit goes out of control and the government borrowing keeps put pressure on the bond market, then also the bond yields will go higher. Now, all the three fronts, we are not seeing a pressure from the policymakers. That is the reason why the bond markets are not going out of control.
Right. But with all of this, if you go to see in terms of, yields on US Treasury bonds, as we know, it's a global benchmark for debt, has surged almost around 70 basis points in the past 1 month. Now, that easing supply has translated into India's 10-year bonds barely climbing some 8 to 10 basis points. So, is there a possibility that we would soon start playing catch up to match what's happened in the US bond market? And if that happens, probably the 10-year benchmark paper should be around in that 7 to 7.2%, 25% kind of a mark.
See, this talk has been going on for quite some time. Global benchmark talk has been going on. But if you want to join the global benchmark, two things are very essential. One is you need to have a very strong external position. Right now, we have a reasonably good external position. I don't know whether it is still enough. If there is a hot money in and out of the country through the bond market. Second is fiscal deficit is extremely important when you enter the global bond markets. I think most of the state governments are not fiscally disciplined, and even central government also needs to bring the fiscal deficit under control. Only after that, only we can enter the global bond market. I think it's. I don't think we can immediately get into that, and this talk can probably have when we see the situation improves.
Right. So overall, if you see in terms of what's happening globally, from the Eurozone to even in terms of US, clearly the idea is that inflationary pressures would probably lead the ECB and the Federal Reserve in particular to hike rates faster and further than what the markets are actually pricing in. If that happens, what's the kind of impact we could see on the Indian market, if that's there, if there's a mismatch globally?
See, we will see imported inflation affecting our markets also in one way because of the rising commodity prices and crude prices. One, if US bond yields start moving higher, definitely there will be some outflow of funds from our bond markets, as well as, hot money, some amount of hot money will go out of the country. But there is one good thing is that if you look at the latest balance of payment data from RBI, our external debt is just around $570 billion, out of which 1 year maturity, the short-term debt is just about $100 billion. So when you have a sufficient amount of reserves, something like $608 billion, we still have more than $30 to $40 billion extra to handle the any outflow. So this can be definitely handled in whenever a situation happens. The what we have to see in good perspective is that last 2 years, when there was a very huge inflow, the Reserve Bank kept on buying dollars, and those were kept in the reserves. And to avoid volatility, Reserve Bank was buying. But now those reserves will help us if there is any outflow of funds. So even if the hardening of global yields takes place, it will have a marginal effect on our market. One. But definitely, I mean, our bond yields will rise a little bit. Probably another, proportionately, if Fed Reserve hikes interest rates by 2% or 3%, maybe our bond yield will also rise by about 1% or something.
Mhm.
That's
Right.
very difficult to say.
So with all of this said and done, what's the kind of impact we're expected to see on the Indian rupee in the near term and in the from a medium to long term perspective?
Yeah, but it's not clear.
I'm saying if with everything said and done, what's the kind of impact that we're expecting on the Indian rupee in the short term and in the medium term?
For the Indian corporates, you are asking?
Indian rupee, INR.
Indian rupee, okay, fine. Indian rupee will come under pressure, definitely. But the Reserve Bank will definitely try to moderate the volatility in the market, just like what they have been doing. One good thing is that the Reserve Bank, whenever there was any recently, they have done two big swaps, $5 billion swaps, and one more $5 billion swap is coming up by the end of this month. This will provide liquidity to the foreign exchange market, and at the same time, it will also help in removing some of the excess money banking system liquidity from the market. So as long as we have that extra 30 billion, $40 billion there, Reserve Bank will allow a moderate depreciation in the rupee. But it won't be a runaway depreciation like what happened in the about 7 or 8 years back, when we did not have enough reserves, but we have enough reserves now on hand. So we don't have to panic at the moment. But when the situation, external situation, commodity prices are very high, food prices are high, bound to be some depreciation. That's bound to be some depreciation, and I don't know how far the Reserve Bank will allow that.
Right. So overall, that's something we need to watch out for as well. Thank you, Mr. Srinivasan, so much for joining us on the show. Always a pleasure to speak to you, get insights from you, and understand what the market is looking forward to. Thank you. Stay safe and speak to you soon again.
It's our pleasure. Thank you.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.